Now that we've collected all of our data, normalized our financial statements, made our projections, collected comparables, and estimated our required net working capital, we're ready to proceed with valuation. The very first thing that we want to do is decide which cash flow to use, SDE or EBITDA. Decide how you want to weight your cash flows, either with average weighting or percentage. Note you can also decide whether or not to include a year right here. Moving down the page, we run into this Valuation Methodologies toggle. Which is meant as more of a guideline rather than a hard rule for which methodologies to consider. If you want to include or exclude a certain methodology, we can override it by selecting Force Include or Force Exclude. If you want to know more about the three approaches in general, or specific methods, we can take a look by clicking on the red cells or bold font. Now scrolling down, we're able to see how this is actually calculated and decide whether or not this method is relevant to the analysis at hand. Each methodology will be explained in more detail in its own video. The last thing to do to determine the MPSP is decide on the weighting on each methodology, which should reflect the amount of confidence that you have in each value, as well as what you have projected for the future. On the income approach in particular, the decision between using a DCF and a multiple of past earnings, such as the multiple of SDE or EBITDA, should be based on how confident you are in your future predictions and how much of the business's value is based on those predictions. The more certain that you are of your predictions and the more the business's value is based on growth in earnings, the more important that the DCF becomes. Of particular note, we can use the DCF to value companies that are currently losing money or whose reinvestment is greater than net income if we expect to achieve a sufficient amount of profitability in the near future. Market data is supported when comparables are plentiful and closely reflect the business that you are valuing. The same is true with rules of thumb. The more that your business follows an established model and fits in with the experience that other practitioners have, the more valid the rule. Note that old data may no longer be valid and merits a decreased weighting on this methodology. Finally, the cost approach is best used when assets compose a significant portion of the business's value or earnings are non-existent or below the required ROIC that the assets demand and are not expected to rebound in the near future.